everybody. Welcome once again to another episode of the Bird Shops Report TV. Today we have Larry McDonald, founder of the Bird Shops Report, and we have Robert Van Battenberg, one of our longtime friends, contributor, and one of our analysts in New York. Guys, what's happening today? Tell me everything about it.
Well, I want to kick it off with Rob's done some great work. A year ago, we did a tax loss basket because last year you had a big divergence between winners and losers. And what Robert's data goes back 20 years, and he found that when you have those big divergence years between a lot of winners and a lot of losers, your performance in January of the tax loss basket can be spectacular. So we bought ARC and Tesla and CRM in December in our what we call our bear traps trade alerts. So and Valentina can help you get on a trial. But we send out trade alerts via WhatsApp and in our Bloomberg chat. We work with about 650 institutional investors in 26 countries. And what we try to do is we try to once a week give you a lens on that buy side conversation. So most of our clients are professional investors, but we try to share that information and democratize information for a broader audience. Our book's coming out in Q1. I think it's gonna be a blockbuster. But without any more of that, let's get into some of the slides, Jose, and let's talk about where is the opportunity, where's the trade looking out the next 3 to 4 months. So Rob, walk us through. What are you trying to say? This is the S&P 500, good years versus really strong years versus then the returns in January. What are you trying to say here?
So the theory is that there's two forces in play towards the end of the year, which is window dressing as well as tax loss selling. Individual investors are inclined to sell their losers in their portfolio towards the end of the year in order to create some capital losses to offset their capital gains. So they have to not pay taxes. And they delay taking profits on the winners until January because then they only have to pay the taxes over those a year later. So if you sell now, if you book a capital gain, you have to pay Uncle Sam in April. And otherwise, in January, if you sell, you can wait until 2025. So
if you're up big on Apple or Tesla, say you're up big on Apple or Google or Microsoft, if you sell that stock in January, say January 3rd, 4th, 5th, then you don't have to pay the taxes until the, I guess, first, second quarter of 2025. Is that correct?
Right. And now the other more important almost factor is the window dressing. So mutual fund managers, portfolio managers, and send their statements to their clients by the beginning of the new year. They want to look as good as possible. So they buy all the winners. So they will buy NVIDIA, they will buy Microsoft, they will buy Apple, they buy the Magnificent Seven, they buy the winners in the market to the point whereby their portfolio is maxed out on them in order to show their investors, hey, look, what a great stock picker I am. So you'll see.
And so in other words, they don't want to show the losers on the year-end balance sheet. They want to show that as many winners as possible.
Yeah, they will pick out their losers. They'll maximize their winners. Remember, most of these portfolios cannot hold for more than 5% in one stock. So there's a limit of how much they can hold in one stock, but they will try to maximize how much they can buy of those winners. And they will essentially reduce their losers. So you have mutual fund managers selling the losers in December. You have individual investors selling the losers in December. And you have mutual fund buying the winners in December. So you have a lot of pressure on losers and upward pressure on winners. So when you look at the table, you see that in great years like 1999, 2013, 2021, 2020.
That's the S&P 500 there, Rob?
That's the S&P 500 performance. The market tends to take back a little bit in January because that's when that buying pressure, that specific buying pressure from these mutual fund managers and window dressing fades away. And that's when some people will just basically take their winners off the table a little bit, take some profits, and they're waiting for January. So to that end, we've seen, of course, that 2023 is looking like it's going to be another strong year for the market. So we should expect upward pressure on the winners until the year end, and a bit of a pullback in January. But for us, more interesting is actually the losers, right? Because you've had a lot of pressure on stocks that have been already down throughout the entire year. So you get the puke in November and December, and those stocks are left for dead by the end of the year. And there's some real bargains in there, right? And some people basically buy them back in 30 days. Your holding periods, the tax law says if you can buy them back in 30 days. So let's say you have a stock that did very poorly this year. Let's say Pfizer. You sell them in December and you wait 30 days. You just buy it back in January. So that is where the appeal is. So when you look at the screen, this is what happened towards the end of 2022. You saw that kind of stocks like Tesla, Salesforce, Disney, GM, Apple, they were big losers in the last 2 months of the year.
Let's get this straight. So this is the performance of some large cap stocks in November and December of 2022.
Right.
Okay.
And so you saw the Teslas, the Apples of this world, Disney, Salesforce, big losers. And you saw stocks like Nike, Procter & Gamble, Emerson Electric were some of the biggest gainers within those 2 months, right? So you had mutual fund managers probably buying a lot of those stocks because they wanted to show how good they were. So that's into year end. And now we're looking at the performance in January, which is the next slide. And you'll see that some of the big winners towards the end of the year became losers in January. Standing out is Procter & Gamble, right? It's it went down in January. Emerson Electric went down in January. So that's, I think, where some of the opportunity lies.
Yeah, all those pharma stocks. I'll never forget. Like the fourth quarter of 2022, it was Merck, Pfizer, all these big pharma names were breaking out all-time highs. At the same time, we had the what we call the Magnificent Seven were in flames. And it was really it was massive outperformance of the industrials versus the Qs. And now, what's fascinating, a year later, it's literally a 180-degree trade of the opposite. And so we have a capitulation model that measures the intensity of selling, the distance below the lower Bollinger Band. We're trying to measure, is this a category 3 hurricane in terms of selling? Is it a category 4? Is it a category 5? And with Tesla last year, we did a couple of trade alerts in December because we were picking up a near category 4 type capitulation where you're trading just with intense selling. You're way below the 200-day moving average. You're below the lower Bollinger Band. Your RSI on a weekly and a daily level, all the readings were just really intense. And lo and behold, Tesla, as you can see there, came out of the gate pretty well. Of course, we didn't hold Tesla long enough in 2022, but we had pretty nice gains for clients in our Bear Traps trade alerts. Next one, Jose. Okay, so Rob has done a great amount of work on Chinese equities, on Alibaba. We've got some clients in the chat. One of the things I think is most interesting is we have clients in the chat. Remember, there's hedge funds, mutual funds, and pension funds in the conversation behind me. They're in 20, 23, 26 countries around the world. And I've noticed a number of people that were really bearish on China equities are now buying BABA. And they're buying KWEB type names. KWEB is a basket of essentially the big technology stocks coming out of China. And the ownership of these equities is at record lows. I mean, we know a lot of the portfolio managers in this space. I was talking to a major chief investment officer the other day, and he goes to Europe once a year in the last like 10 years, and he just went back off a trip, and he said, Larry, literally we would have 2 rooms, we would run out of donuts, run out of coffee, and this year 5 people showed up. I mean, it's just nobody cares because of the whole dynamic with Russia and the whole disinvestment out of some of these Russian equities, which has scared investors. Every investor is terrified of investing in China equities. And if you look at the meeting with President Xi this week, and Rob, you can get into that a little bit, but the backdrop is pretty attractive. But I think most of all, from a technical point of view, the outperformance of the Qs versus KWEB is, that's a triple top spectacular level to get in. So if you're long a lot of Q type names here, it makes sense to either sell some upside calls or maybe sell some of the Qs and buy, because the KWEB names are trading at one of the cheapest levels to the Qs, all time. Rob, what are your main 1 or 2 very short bullet points on the whole China dynamic year end with President Xi and President Biden meeting this week?
Yeah, the meeting starts at 2 p.m. The expectations are very low in terms of what kind of deal can we get. Right, they're going to do something on fentanyl imports, and they're doing something on military communication, but there's no real breakthrough expected. So that sets you up for a very, very attractive baseline. So the risk reward there is very appealing. Chinese economic data this morning or overnight came in rather bullish. The economy is still essentially accelerating here. The People's Bank of China, the central bank of Beijing, is adding liquidity again into the market. And on top of that, China is extremely...
What is that for the average investor? So what does that mean? So the central bank of China is adding liquidity. How does that translate? That obviously helps stocks?
Yeah, it helps stocks. If you have excess liquidity in the market, that liquidity has to go somewhere. Where does it go? It can go to properties, it can go into stocks, it can go to fixed income. But adding liquidity is generally positive for the market. I think there's one thing that Ben Bernanke has proven to us is that excess liquidity generally favors stocks, because that was his whole policy, drowning the market in liquidity until the stocks went up. So that's one aspect of it. We know that Chinese policymakers want investors to get more into stocks. Chinese households own the vast majority of their investments is in property. The property market is in the doldrums, and now policymakers want to shift more of that wealth, and that's a lot of wealth. That is as much as U.S. households have in wealth. They want to put that more into stocks. So there are a number of really powerful factors that are in favor of Chinese stocks.
Yes, and Rob, let me ask you a question. So there was an institutional investor in the chat, a pretty famous investor from Texas, who was talking up this consumer investment liquidity on the sidelines in China, excess savings. What was he getting at? In other words, he said it was like what happened with the U.S. We had all that excess liquidity, excess savings after COVID, and a lot of that went into equities. But what was he getting at in the conversation?
Excess savings in China are much higher than they ever were in the United States after COVID. So if the Chinese start spending, they can spend a lot of money. Now, the Chinese are not U.S. consumers. They don't consume like the way U.S. consumers do. No one in the world does it the way the U.S. does. But there's a lot of excess savings there. And the Chinese also have a propensity of, according to this investor, of paying down their mortgages. So that maybe some of the money goes there. But the bottom line is this. The Hang Seng Index trades at 8.5 times forward earnings. Europe trades at 11 times. Right, and the Russell trades at 14 times. These stocks, these companies,
Russell 2000 in the U.S.
Yeah. Yes, the performance of these companies is extremely mediocre, but yet they trade at a multiple. They trade 20-30% higher than China. China is at 8.5 times. That's pricing in stagflation. China is the only country in the world that actually has disinflation. China is the only country in the world, major country in the world, where the central bank can actually cut interest rates, right? And they're doing that all the time. It's mesmerizing to me. People say, well, China is Japan. No, it's not. China is not Japan. Japan was coping in the 1990s with a massive appreciation of its currency. The yen went from 120, 130 to 80, which is almost a 50% appreciation of the currency inside of 4 or 5 years. And Japanese equities were still trading at 20 times earnings. What?
Yeah, so that's versus the dollar. So 120 to 80 is strengthening.
Yes. So you had to pay 120 yen in order to get $1, and then it went to 80. You only had to pay 80 yen to get $1. So it was a massive appreciation of the currency of a country that is almost exclusively relying on its massive export machine to keep the economy going, just like China. But China's currency is going down versus the dollar, right? They have currency depreciation. So they're becoming more competitive. So the analogy between Japan and China is idiosyncratic. It makes no sense at all.
Makes no sense.
Makes no sense at all.
And so when I look at this chart, I just want to bring back to the chart. Everything you talked about earlier, right? Okay, talk about. I think you did the math. You can now fit more than 10 Alibabas inside of one Apple. Both companies have massive, massive risk to China. Apple's whole production capacity is based in China, and if there are hostilities in terms of trade, to say the U.S. pension system doesn't allow investments in China equities, China can pull a lot of nasty moves with U.S. companies right now. And so, if you look at that chart, you're talking about an exponential, a lot of people selling Alibaba, taking the loss, and they're going to buy it back in 31 days. And a lot of people maybe not selling Apple until the new year. Yeah, so in closing from that, we're seeing some clients get long Alibaba, clients that were bearish on Chinese equities. They're buying Baba versus short Apple. We're seeing a lot of intelligence in this space, and we're really bullish on Baba for, say, the next 6 months in terms of tax loss victim, where you come out of the gate, and by the second quarter of 2024, probably in a much, much better place there. In terms of this slide, Rob, so yesterday, your advanced decline, so talking about we're in a situation where the breadth this year, and that's the advanced decline, there's been very, very few stocks that have been holding up the market. Everybody knows that. Right now, there's 5 stocks that are 3% or more of the S&P 500. 5 stocks that are 3% or more of the S&P 500's value. And 10 years ago, there wasn't one stock. Not one stock was 3% of the S&P 500. Today, we have 5 of them. And so this year, it's been an incredibly crowded trade. Everybody's in the same names. Everybody's in the same stocks. It's a very dangerous situation. And what happened, and Rob, you can get into the triggers of this, but we saw this week a historic shift. The performance of the Russell versus the S&P, a 3% single day outperformance of the Russell 2000 versus the S&P. So something's going on. Money is a migration of capital. Some money's migrating out of some of these big names. And I think you said yesterday, Rob, if you're in a stock like Microsoft, that can be a funding mechanism to actually sell that and diversify into beaten down tax loss names. And we were just on the phone 5 minutes ago with a famous institutional investor, and he set up an internal fund within his fund to take advantage of this, and they started buying in November. A lot of people think that tax loss buying starts in December, but a lot of players are getting out in front of this. That's why we're doing the call today. But Rob, get into what you're seeing here. I mean, you think about how bad COVID was in terms of the market, and then coming out of COVID, you have those advances versus declines, that very, very strong breadth.
So what we saw was essentially in one or the other every single day since, let's say, the middle of 2021, That performance is masked by some heavyweights who are keeping the index higher, at least until 2021 and in 2023. But beneath the surface, a vast majority of stocks have gone down and have essentially made 52 more lower 52-week lows day after day for multiple months in a row. I hope we can see that chart later. So the pendulum has shifted with yesterday's CPI data, and whereby essentially a cloud was lifted over the market, at least temporarily, and a lot of money started to buy these beaten down names again. And this is the single most important reason why the advanced decline line flipped to so heavily positive. And I think that speaks also to some of the cautious sentiment out there for stocks in general. We've seen that in many different data sets. Individual investors, even institutional investors, were rather cautious, and I think they flipped the switch after seeing those CPI data, and there was a broad-based buying in the market of both in some of the tech stocks, but especially in some of the beaten down stocks. That's basically what you're seeing here.
Hey, Rob, enough about Wall Street. What does this mean for Mainstreet? For your retail advisor, for your retail investor?
Thank you, Valentina. Yeah, what does this mean for Mainstreet? So here's a perfect example. You see on the left-hand side there, you see all of those very strong ratings above. Valentina brings up a great point. For Mainstreet, what does this mean, not Wall Street? The most important thing here is when you have a spectacular advanced decline day where the market has broad distribution of stocks that are up, instead of a small amount of stocks that are up, you've got a very large portion of the Russell 2000, very large portion of the S&P that are higher. And what you want to see to confirm that this is a real bull market is a lot of readings, on the elevated side. So you can see there on the left-hand side of the screen, as we're coming out of COVID, you see all of those readings. That's a follow through in advanced decline. So that means the market was in a new bull market coming out of COVID, and the market ripped from March 2020 well into 2021. And so you want to see that continuation of that strong breadth. So for people on Mainstreet watching us right now, we had the strong day this week, but you notice back in the summer, we had one or two really good days, and you see how there was no follow through. And lo and behold, by October, the S&P lost close to 11% from the highs, and the NASDAQ, I think, a little bit more. And so I think for people watching us at home right now on the retail side, for Mainstreet, you want to see a continuation in this breadth, this strength over the next couple of weeks. And every night, Valentina can tell we put out the Beatrice report. We do what's called a recap of our buy side conversation. So we're giving clients a lens on that professional conversation. We're kind of like bringing Wall Street to Mainstreet. But I guess next one, Jose. Okay, Robert put this chart together yesterday. I was blown away. So this is days when the IWM, which is the Russell 2000, so 2,000 stocks, versus the S&P 500. This is days when the Russell 2000 outperforms the S&P 500 by more than 3%, which is very, very unusual. As you can see here, there are not many instances since 2006. But what's most interesting about this chart is this speaks to moments in turns in the market. A lot of times, these results are in near market bottoms potentially, as you can see there, and follow on outperformance of the Russell versus the S&P. Once you get some of this price action, it's an indication of future outperformance of the Russell 2000 versus the S&P 500. And so, Rob, when you put this together, what were you looking for? And I think you looked at the regional banks as well.
Yeah, that's a different chart. Yeah, there are more instances in which regional banks outperform large cap financials, but this is very, very rare. I think the last one prior to the one yesterday was when Biden got elected in 2020. We had a significant outperformance of this. And then, of course, you had a few instances just after the market bottoms in the bottom in the Corona bottom, when the Fed, of course, went all in. And yeah, these are powerful signals. And I see like 90% of the time it happens near market bottoms or at the start of a big bull run. This chart, which is what I was discussing earlier, is the number of 52-week highs, 52-week lows. So we saw during the great financial crisis, basically 2 years of the number of stocks making 52-week lows, vastly outnumbering the number of stocks making 52-week highs. That happened for 2 years in a row, basically started in the fall of 2007 and didn't stop until maybe the spring of 2009. So there are periods of time where this phenomena happens, but that 2 year crossing the desert, whereby you have such an enormous amount of stocks making new 52-week lows relative to new 52-week highs, that we haven't seen until the last 2 years. So we saw it in after the great financial crisis, and we saw it again from the end of 2021 till the end of 2023. It's a big drawdown, a lot of smaller stocks, a lot of stocks that are under the radar screen. We're not talking Apple here or Microsoft, just basically making one 52-week low after another. So this has been a long period.
Rob, so whoever made this chart, you cannot see the years at all. So I need you to very clearly tell the audience what this is. Is this the these are 52-week highs versus lows. What periods are those ovals? And is this the S&P 500? Is this the NASDAQ?
Well, it's the Bloomberg US Composite, so it's a broad index of stocks. So, they don't compile it for the New York Stock Exchange per se or for the NASDAQ. They compile it for a broad segment of the market. And this is from 2000 to 2023. So the first circle to the left is, of course, the 2 years after the financial crisis. So from 2007 to 2009. And the second circle were the last 2 years, essentially started towards I would say...
Rob, that the intensity of lows over the last 2 years, if you look at the breadth of that red, that's on par with the financial crisis, almost. I mean, that's kind of mind-blowing. That shows you how many stocks are underperforming the market. The market's actually crashed internally. People don't get that. The market has already crashed internally.
Yes. Yeah, we've had basically a 2-year bear market, stealth bear market, yes. 2021 was not that stealth, but 2022 was not that stealth, but 2023 for a lot of stocks, it was no better. So you have 2 years. Where do you go from here? No one will tell you, but if the 2 years is a long period of time for that many stocks to be down that much and for that long of a period of time. So I thought it was a very powerful chart, and I hope it resonates with the investor.
And so if you look down the bottom right of that right-hand oval, it says 4,000. So we actually touched the 3,000 to 4,000. This is my point. I want to really look at this. If you look at the data in that right oval, we crossed 3,000. Looks like more times than during the financial crisis of 2008. That's 3,000 stocks that are hitting 52-week lows. Is that what it's saying?
Yes.
I mean,
it's a big number.
And so, so what does that mean for 2024?
Well, net, right? So it's net. So you have, in the index, you have the number of stocks that are making 52-week highs minus the number of stocks that are making 52-week lows, which gets you a net number. Yes, during periods in 2022, the net number was 4,000 stocks. Even during the last sell-off from July to October, you have a lot of stocks making 52-week lows, and very that's it's broad, right? So it's not a few stocks, but this is a large number of stocks that make 52-week lows. So there's a lot of pain out there. There's a lot of pain out there. There's a lot of pain in a lot of stocks. And that's masked by a number of heavyweights that are keeping the indexes up. But, beneath the surface, and that goes back to our earlier point, beneath the surface, there are a lot of opportunities towards year end when you believe that some of these stocks have been completely washed out. And the only reason why they're still going down is because people are selling them begrudgingly because of tax reasons.
Yeah, and I was on Fox with Maria Bartiromo in the spring, and you had picked up. It's actually like late February, or was it late February? You had picked up on the weakness in the regional banks in February, and then they all crashed in March. And so I made a very rare kind of crash call. And I'll just defend myself. In some ways, we were right. There are a number of sectors within the market, whether it be retail, whether it be the banks, insurance companies. There was a massive crash inside this market. You can just see it right there. It's a mathematical, historical fact. All of that red on the right-hand side, points to a real nasty period the last couple of years in terms of stocks making new lows versus new highs, and just very, very few names are holding up the market, and that's what makes me think about January. Because if you think about January, if you're in one of these names that has a lot of gains in 2023, and then you get that kind of flip like we had in 22, where people start to sell the winners in January, you could have a pretty interesting impact on the market in January relative to December. And I think that's really important. Okay, thanks everyone for joining us. As a reminder, we run one of the largest institutional chats on Bloomberg with buy-side investors, and we recap that conversation for a broader audience, and we really appreciate it. So if you know somebody that wants to be part of the chat, you just reach out to Valentina, or if you know someone that wants a recap of that conversation with our trade ideas and our tax loss basket for 2024, Valentina can help.
Thank you so much, Larry, and thank you so much, Rob, for joining us today. We're very happy to have you here. As Larry just mentioned, you can reach me out at valentina@thebirdshopsreport.com. That's valentina@thebirdshopsreport.com, or you can use the link below. I can give you a 21-day free trial on either our reports on our Bloomberg Live chat. Also, remember, we're coming out with a new book in Q1 of next year, and you can also pre-order that now in the link down below. Remember to subscribe to our YouTube channel and turn on the notification bell so you can be the first to get all of our videos. Thank you so much, guys.